Sometimes, when an investment trust is looking to grow its assets, the trust may issue subscription shares, also known as warrants. These can then be converted into ordinary shares in the trust at a later date at a fixed conversion price for a fixed period of time. This is described as a subscription right, and shareholders are under no obligation to convert the shares if they don't want to. For example, you may receive 1 subscription share for every 5 ordinary shares held. Whether or not it's worth converting the subscription shares will then depend on how the share price of the ordinary shares changes after that date. If you receive your subscription shares for free, the situation's quite simple. If your subscription shares entitle you to convert them into ordinary shares at £1, when the shares are trading at £1.50, you'll comfortably profit if you convert your subscription shares. You'll save 50p per share by converting them compared to buying them in the open market. If the ordinary shares are trading at 50p, however, you're unlikely to want to convert your subscription shares because you could buy the ordinary shares elsewhere more cheaply. If for any reason you don't want to convert your subscription shares, you can also sell them on the open market. This may be a good choice if you don't have sufficient capital to invest further, or if you don't want to increase your exposure to the underlying asset but would still like to benefit from holding the shares. For some more sophisticated investors, it may also be possible to buy subscription shares on the open market, with the value of the subscription share being loosely related to the difference between the exercise price of the subscription share and the price of the ordinary shares on that day. At launch, subscription shares often have very low purchase prices, meaning a relatively small movement in the market price of the ordinary shares may result in a disproportionately large movement, either up or down, in returns on the purchased subscription shares. The market price of the subscription shares may therefore be volatile. While upside returns can be substantial, it's important to understand that these products are complex. You could lose your entire investment and the subscription shares expire worthless if the ordinary share price is below the final exercise price of the subscription share at the end of their lives. If you hold subscription shares that were purchased, it's important to factor in the acquisition cost or the possible sale value of the subscription shares before deciding whether it's worth exercising the rights. For example, if subscription shares exercisable at £1 were purchased for 5p, then the ordinary shares would need to be trading at £1.05 or more for the total cost to be lower than buying the ordinary shares directly. If, however, you could sell the subscription shares for 15p, realising a profit of 10p, and the ordinary shares were trading at £1.05, then you'd be better off selling the rights and buying the ordinary shares than converting the subscription shares. It is, of course, important to factor in any other trading costs that you may incur. We always recommend that shareholders consider closely whether it's worth exercising or selling their subscription shares prior to their final exercise date, as they can expire with no value should the final ordinary share price be below the exercise price, even if shareholders could have made positive returns previously. The share price of both ordinary and subscription shares can go down as well as up.